In this video, I'd like to talk a little bit about my story, why I decided to get involved in individual stock investing. When I began my career, I heard the conventional wisdom, you should just buy the S&P 500 index, just dollar cost average with every paycheck and do that for your entire career. That's the safe and smart thing to do because you can't beat the market. So just do that. The market will give you 8 to 10% returns year after year and you should be fine. Well, when you plug those numbers into a spreadsheet, it certainly looks doable. And so I did that for the first 15 years of my career. And I actually went through several different jobs, and so I used several different retirement funds, but in each case I always chose the option that was the closest to the S&P 500 index or a total market index. In 2018, I started to realize that my accounts were going nowhere. It seemed like the only growth was coming from the new money that I was investing. It didn't seem like the returns were adding up at all. And so I did some math and I looked at the S&P 500 returns over those 15 years I had been investing. And the average return was 8.6%, and that's without dividends being reinvested. In my actual accounts, I had been reinvesting all dividends. Nothing had come out of my account for those 15 years. And when I did the math, my actual real returns were 5.5% growth per year. Now, my initial reaction was, how in the world could this be happening to me? How could I only be getting 5.5%? And then I started doing some research and looking at the math. There were really two things that were destroying my potential returns. One was the fees, the investment fees that were charged to my retirement accounts. You got to be careful about these. Whether the fees are being charged in a straight dollar amount, maybe they're charging a certain amount per quarter or per year, or they can be charging a percentage, or in some cases they may be charging both. Unfortunately, sometimes your employer has chosen a fund that doesn't really disclose this information very easily. You have to go digging for it. You have to ask for an explanation on the fees that you're being charged. Otherwise, you'll never see them on the statement. The other thing that gets lost in the math is when you look at a large number of years in a spreadsheet and you start to say, well, these are the average returns year after year. We talk about that the growth expounds on itself, that the growth is exponential because your growth is getting you more growth and your money is making more money. But the destruction of capital also works exponentially. And so if you've never really considered it, when the market has a down year and you actually lose money, when you start to figure in those average returns, the destruction actually counts much larger than the positive numbers. So to really understand how the destruction of capital really hurts worse during negative return years, let's use a very simple example. Let's say I start with $100. In the first year that I invest, I have a 50% return. I'll go from $100 to $150 in my account. The very next year, I have a negative 50% return. That will take it from $150 down to $75. Now, if I averaged out my rate of return, I had plus 50 the first year, minus 50 the second year, my average return would be zero. So if I just told you I started with $100 and I had a 0% return over 2 years, you would expect to end with $100. And yet I'm stuck with only $75. Now you may think, well, that's just because you did the negative afterwards, Jeff, but it's not true. If you start with 100 and you say negative 50% the first year, you go down to $50, and then the next year you go positive 50%, again, you end up at 75. Either way, if you have any negative returns, the destruction of capital is exponential and hurts you worse than you expect. So you can try this for yourself. Take any number of years, take percentages that are the returns, and as long as you have one negative in there, when you compare the average rate of return that you would expect with the real results, it will always end up lower. So unless you're counting on the stock market to never have a negative year your entire career, you need to factor that in when you're making your calculations. Punching in a positive rate of return into an entire spreadsheet for 20, 30, 40 years is not going to show you a realistic expectation. So what's the answer then? Well, for me, the only option was to take charge of my investing and start managing my own choices, to take control and make investments that could return much more than the average, so that at the end of my career, I can retire well. If you find that your answer is the same as mine, I encourage you, take control, take charge, get engaged, and start making your own decisions. If you'd like to talk stocks and stock market investing mindset, this is a channel that I think would really suit you. I hope you stick around. Have a great day.